So I guess, so now we kind of got a lot of the basics down. Let's move into part 2 and look at the different types of like loans and some closing questions here. So let's go into probably the big question first is, what are the different loan types and what are the differences between them? So I'm thinking like conventional, VA, all that good stuff there.
All right, let's start with conventional.
Okay.
So conventional is where when you hear of Fannie Mae and Freddie Mac, that's conventional. Those are the agency conforming or conventional loans, where if you don't, here's where that 20% down comes into play. If you don't put 20% down, then you will be required to pay private mortgage insurance. I think a lot of people have heard of PMI or private mortgage insurance. And then there's FHA, VA, USDA. Those are what we call the government loans, where they're endorsed and backed by government agencies. Some of the advantages of FHA, VA, USDA are lower interest rates than your conventional loans and more flexibility, and they're a little more forgiving than conventional guidelines and standards. USDA, if the property is qualified, 0 down payment. It's beautiful.
So that would be more like rural type communities than for the USDA, correct?
You got it.
Is there like a website you could look at maybe?
There is.
Okay, cool.
Yeah, and it's open to the public. You can, if you Google USDA property eligibility, it'll take you to the USDA's website. You can click on the property eligibility section. I like to do this when I have buyers who are interested in the USDA option. And you can search by address. You can zoom in on the map and look at the non-shaded areas, and it'll tell you if the property should be eligible for, or if that area should be eligible for USDA financing.
Right. So the entire area is not just specific houses or anything like this?
Correct.
Okay.
It'll say this should be a or if you put in a specific address, it'll tell you if it should be USDA eligible property.
Gotcha.
VA financing can be great if you're a veteran and you're looking for 100% financing. We have a program right now called Zero Down for Heroes. So not only is it 0 down payment, we charge 0 lender fees.
Oh, fantastic.
And we have highly competitive rates. I love our VA program.
Excellent. Does the VA loans take like longer to close or anything like that, or are they pretty standard these days?
It's pretty standard. If a lender has their operations game together, they should be able to close in 30 days, no problem.
Gotcha. Perfect. And then,
or sooner.
That'd be even better, obviously. Yeah. So, like, kind of going into this more details of the loan, explain to me, what are like income and debt ratios? I hear that a lot in sort of the lending industry there.
Sure. There's actually 2 of them.
Okay.
There's the front end or housing expense ratio, where we divide your total housing expense. So that's your mortgage note payment, your property taxes, your homeowner's insurance, and mortgage insurance if you're paying it. So we take your total monthly housing expense and we divide it by your gross monthly income.
Okay.
That's your front end ratio. And then there's your back end ratio, which is really important, where we take that housing expense, monthly housing expense, and all of your other monthly credit expenses. Not utilities, we don't care about that in most loans. In most cases, we're just looking at credit cards, auto loans and leases, installment loans, student loans. Even if they're in deferment, we're still required to use a certain percentage of that balance and calculate that as a monthly payment.
Okay. Gotcha.
So we take all of your monthly credit expenses, lump that in with the housing expense, divide it by your gross monthly income. Hopefully this isn't too confusing.
We'll put a little formula up there.
That's your ratio.
Perfect. No.
Yeah. And we want to keep it under a certain amount or under a certain percentage depending on the type of loan.
And like on a standard type of loan, what does that percentage look like?
It can vary. Anywhere from 41% on your traditional conventional loan to VA, we can go up to 60%. I don't know if I should be telling that.
No worries.
VA will let us go up to 60%.
So really, though, you want to be closer to that 40% ballpark area.
That's a good place to be with government loans. Sometimes we can get away with certain types of government loans. Sometimes we can get away with a slightly higher back end.
Gotcha. Perfect. And then when it comes to like the mortgage itself, I hear the term like buying points or mortgage points a lot. Can you speak a little bit to what that is?
Sure. What a lot of people are hearing is when they hear about buying points, they're talking about discount points.
Okay.
And the simplest, I don't know if this is the simplest way to explain it,
sure,
but the way I learned when I first got into the business a long time ago is that discount points are considered to be prepaid interest.
Okay.
So you can pay interest up front to the lender in exchange for a lower rate throughout the life of the loan. Each discount point is equal to 1% of the loan amount. So on a $100,000 loan, 1 point is equal to $1,000.
Okay.
How much lower of a rate that gets you depends on the lender.
Gotcha. So if I'm understanding correctly, then basically you pay a little bit more upfront, but then less in interest over the length of the loan then.
Correct.
Okay.
And it gets you a lower monthly payment, which is
Gotcha.
really helpful sometimes.
So if you're going to be in the house for a lot of years, this is definitely a good thing to explore. If you're planning to just be there for a couple years, maybe it doesn't make as much sense to do.
Absolutely.
Okay,
Yeah.
perfect. And then I think you touched on this a little bit before. I was hoping to learn a little bit more about like mortgage insurance, kind of what that is, how do I need it, is there a way to get rid of it, all that good stuff.
Sure. Well, anytime your loan amount exceeds, or the higher your loan amount is in relation to the value of the property, so what we call loan to value,
Okay.
loan amount divided by purchase price or property value. Obviously, the closer you get to the value, the higher risk the loan is.
Sure.
So whenever someone's putting less than 20% down, that's pretty risky for the lender, and they need to be ensured that if anything happens, that they're covered and that their money is covered and protected. So they will require, on a conventional loan, private mortgage insurance, which there are a number of different ways we can structure that, but there's monthly and then there's upfront mortgage insurance depending on your situation. And when we actually have this nifty calculator, some of us have access to a nifty little calculator that will tell you the cheapest and most cost-effective way to go for your borrower or your buyer, depending on the length of time they think they'll be in the home.
Okay.
But yeah, they can pay it monthly or they can pay it in a lump sum up front.
Gotcha. And like with the ever-changing environment of like interest rates and all these good things right now, is there a way for us to like lock in an interest rate, or are we kind of just stuck to the whim of the market right now?
I love that you asked.
Yeah.
If you're working with a good lender, then you should be able to lock in your interest rate while you're still shopping. And that is part of my attraction to Guaranteed Rate Affinity, is we have the ability to lock in for 90 days without a purchase contract. And well, let's say rates drop while you're shopping. Well, guess what? If you get into contract while those rates are still down, we can look into your renegotiation options.
Gotcha.
So you're not stuck at that higher rate when rates drop, but our 90-day lock does protect you from this volatile rate market that we're in, and protects your rate from increasing while you're shopping.
Excellent. No, that's huge, because I know I had a couple of clients that literally went from like a 3% to like a 5% almost overnight, and it just changed their buying value by like $100,000. You know, it's crazy what it can do. So
yeah,
perfect there. And I guess kind of going back to some of the things like the different costs that are incorporated inside the closing. Can you explain, I guess, what are closing costs? What should be captured in there? Like, what could people expect? Not necessarily a specific dollar amount, but just the basket of things that are included in that.
Yep, absolutely. So let's start at the top, section A. When you get your loan estimate, it's going to be broken down into different sections of the alphabet.
Okay.
Section A and B are going to be your lender cost. Well, your cost associated with the loan. So section A, or the top section, is going to be lender closing cost. That's our processing fee, our origination, what we call origination charges, processing, underwriting. Appraisal fee might show up in section B, third-party fees like credit report appraisal. So sections A and B are what you want to look at when you're comparing lenders. When you moving on down through the loan estimate, you should see title charges. Lender's title insurance is always going to be required when there's a mortgage involved. I'll say that again. Whether purchase or refinance, you will always see lender's title insurance when there's a mortgage involved. Then you're going to see your title costs. That's not something we control.
Sure.
That is purely on the title company.
Gotcha.
Moving on to the next side of the loan estimate, you will see escrow reserves, things that you'll see no matter what type of loan that you have. If you're setting up an escrow account, and for the first-time home buyers out there, that is an account set up for your lender to pay property taxes and homeowners insurance.
Okay.
So you'll see your escrow reserves, property taxes if they're required to be paid. Lender credits also show up on that side if your lender's tossing you a credit.
Okay.
That's always a nice thing to see. Recording fees, government charges. There's going to be recording fees associated with us recording that mortgage down at the county recorder to tie that property to your home. Sorry, I'm diving into a lot of detail.
That's good. Are any of these costs like negotiable, or are they pretty, set in stone? Like, should a lender or a borrower just accept it for what it is?
As far as lender cost or all the costs?
Because I know I've seen a couple of these statements and they're just like a huge list of 1,000 different things, and I don't know if like some of the particular like the title fees and stuff, are those all negotiable, or are they just...
So you may be able to negotiate certain costs with the seller on a purchase transaction. You may be able to negotiate and get the seller to pay certain portions of your title costs.
Gotcha.
Some areas, it's customary for the seller to pay certain portions of the title costs. As far as whether lender fees are negotiable, that's up to your lender.
Gotcha.
I can tell you that I do not have the power to negotiate fees here at Guaranteed Rate Affinity, but if you show me a locked-in loan estimate, I can bubble that up the chain and see if we can compete.
Gotcha. Perfect. So yeah, pretty much set in stone. Then it sounds like there's a couple wiggle room points, but most of it's pretty set. Got it. Perfect. And then so looking more at the day of closing. So I'm the borrower. I'm coming in. What do I need to bring with me to the closing table? Is there anything like super important document-wise or anything like that?
Absolutely. Okay. Please bring an unexpired government-issued photo ID and ideally a second form of ID. I've been hearing more and more that they're requiring 2 forms of ID now at closing. Back in the old days, we were okay with 1 form, but I've been hearing more and more that they need 2 forms of ID at closing. And then, of course, your money. If you haven't wired it in advance, and you should know, whether from the title company or your agent or your loan officer, how much and whether or not your funds need to be wired.
Right.
In some cases, if you're not bringing a whole lot to closing, they may accept a cashier's check still.
Okay.
So
there's like not a whole lot. That'd be like under $10,000 type of deal.
You got it.
Perfect.
Have you heard this rule before?
No, I just like that seems to be the cutoff that the government cares when you make more than $10,000 for whatever reason. So
Yep.
Cool. Perfect.
That's what it is right now.
Awesome. And then let's say I'm flipping the script. Now I'm the seller at the table there. We're closing everything. How long does it take from closing on the house to me getting the money in my bank account that I can go buy a boat or whatever I want to do with it?
That's largely dependent on the title company and how they operate.
Okay.
But ideally, your loan should be funding the day of closing. And if you opt to have your funds wired, there may be a delay, but they should, once the documents are signed and they have all of their funding requirements, then the title company should be paying you, hopefully, same day.
Okay, so pretty quick then.
That's what I would think.
Beautiful.
But
48
I
hours.
don't work for a title company.
Yeah. But reasonably 48 hours or less is pretty standard then for most transactions.
For a seller, absolutely.
Excellent. Thanks for making it through the video. Zack Linder here from Zack Linder and the Zack Pack, powered by Codwell Banker. Make sure to like, comment, and subscribe. It does support our channel. We really appreciate it. And check out one of these other videos while you're here. Have a great day.